Welcome, everybody, to the Alternative Investing Club. Today is April 19th, 2024, and we've got a great speaker for you today. We're going to kick it off, first of all, with a little bit of announcement. 3 weeks ago, we had DLP Capital come in, and that kicked off a conversation about starting a club fund for people that were interested in coming into larger, more institutional type investments, but at lower minimums. And I've been working through, a little bit of serendipity, actually, as it turns out. The paralegal and the legal person that I've been working for are apparently employees of Paul Larson, our speaker today. Actually, the paralegal is. I'm not sure if, but anyway, he works for you apparently. So it's a little bit of serendipity there. Our alternative investing club fund is in the process of being formed. We're supposed to be getting the legal paperwork by next week. The other major thing that happened is we brought on a fund administrator. We're using NAV Consulting. So they're the ones that actually physically move the money around, manage the investor portal. There'll be a mobile app that you can use in order to track your investment at the Alternative Investing Club. And the whole idea is to make it easier for people to group together their investments. DLP, for instance, had a $200,000 minimum. And if we can create a fund that will let people come in at 25K and get 8 people like that together, that would meet the minimum, we would put that in. So it's a service to the group here to try to make it easier to invest and to diversify amongst a lot of different people, which the fund would be diversified. So that is going on, and that is the only major announcement that I have. Does anybody else here in the club have any announcements before we turn it over to Paul? Actually, one other thing that I wanted to say is I'm actively working on a way to make sure that people who traditionally had not been accredited and investing in 506Bs, I don't want to just leave them behind with a 506C fund. So I'm working with TribeVest and a couple of other people to try and figure out a solution that'll work for 506B investors also. All right, Paul, welcome to the group.
All right, well, welcome. Good to see everybody, and really excited to be here today. It's Friday, so I am just thrilled to be here with you all. Daniel did a great job teeing up what you all are trying to do. I think it's ingenious. It's just really neat to see a common group of people that have a common background looking for ways to diversify income. And so what I'm going to do, I'm going to focus today on how do people use alternatives, and in particular, save taxes. And what I'm going to do is I'm going to actually show a case study to give the highlight reel as far as how do you tie this together. Sometimes when you talk about a concept or a theory, it kind of comes in one ear and goes out the other until you can apply it. And so my aim here today is that I want to show you a real life person. We've extracted their names, of course, and then we're going to tie it in. Since we have so many from Intel, I'm going to tie this and try to get very precise with how to use alternatives. Intel, you've got stock, many of you, and then tying in taxes. So a little background, just briefly. Larson Financial started 2006. We have hundreds of employees. I have maybe 300-400-ish. Manage about $7 billion of assets. The picture of the building is where I'm sitting right now. We are headquartered in St. Louis, the beautiful city of St. Louis with the Arch, and we're really thrilled to be here. So let me maybe just give a little bit of context because I think this will help you understand how we approach the world and how we look at things. Our mission statement is empowering all to flourish, and so when we think about that, a lot of people when they're
make sure you change later, okay?
When they're trying to define what does it mean to flourish, a lot of folks will come back to me and say, if I could have more money and not pay so much in taxes, I feel like I could deploy it here or here or here. So that's what I'm going to focus in on to give you some background on our structure, which allows me to be able to speak at this perspective, coming from a tax focus. Is that we have created a one-stop financial resource. DLP, Don Winter, great guy, focuses in and building out portfolios and buying lots and lots of multifamily. We think that's great. We also have, and we do a lot of that. You'll hear that today. But we also focus in, we have 42 full-time accountants. And then we have property management and on and on and on. So all these pieces coming together allow us to really help try to solve some needs here that many of our investors are facing when they're dealing with alternatives. So let me skip through some of this. I'm going to fly through some of the material, and I want to get into what some of this is doing. This is where we have offices. We have investors in every state. This is where we're putting our capital, the darkened states, for our alternatives. And I'll share with you why that's important as it relates to taxes in a minute. But when you think about this question about creating wealth, I think you could boil down and sum up the conversation by saying this: when you are controlling your tax bill, this is your focus, and it becomes your focus. It's all about how much do you keep, not how much you make. And I think many, many times people are looking and emphasizing perhaps the wrong thing. They're talking about an IRR. They're talking about, whatever their income is, or, they're talking about that level of information. And I think that's good. I just don't think it's the most important. If you think about the approach of building wealth, it's like a big bucket. And when you fill the bucket, that's amazing. But if you're losing it out in holes in the bottom of the bucket, namely taxes and fees and things like that, it's just added work. You're churning money, and and there are more efficient ways to do that. So I want to talk about this particular client, and I want to dig into a little bit about how do you connect in alternative investing with a normal life of a person who's looking to reduce tax. So this is a real person. This is a 48-year-old. This person happened to be a doctor that owned their own practice, and they were making an income of $120,000 on the base salary, and then they were paying themselves for surgery center and bonuses through their business another $480,000. So they're a pretty high tax rate. They had their practice. The business was $4.5 million. They had some stocks that had appreciated. And then you had a 401k that they had funded a little bit. They start later in their career, so there wasn't as much in that as what would be normally tied to this. So some of the things on the left were the topics that we brought up: opportunity zone funds, using IRAs and converting them, alternative investments inside of there. So that's what we did. Because we have so many Intel people on here, I thought I would go ahead and use this as an example. So here's the last year of the stock for Intel. And as you can imagine, when you work at Intel, a lot of the engineers and the folks that we've worked with that are employees of Intel, they pick up these grants and these RSUs and all these different things where they're getting stock, and they're asking the question about, like, when should I get out? How do I sell, and how do I do it efficiently? It's vesting, and now I got to pay income tax on it. And what do I do? Or I invested my cash in it and it's gone up, and I want to rebalance and reallocate to diversify, but I don't want to pay tax. So if that's you, and you've got an appreciation, or you've got something you're trying to get rid of tax on the capital gain, there are these things called opportunity zones. And so if you're not familiar with it, I'll just briefly go over the structure, because it was part of 2017's tax reform that came through when Trump just entered office. And he actually added this piece because Barack Obama and Biden both really liked it. It was presented to them, and they were like, this is great. It's a way for people to take appreciated stock and sell it, or sale of real estate or something else that is a gain. And you get to take that and you get to slide that into a pre-tax or an account that deflects and defers the tax. So it's a pretty slick structure, and it really motivates people and compels people to take, in this case, using the example of let's say selling some Intel stock at a gain and reinvesting it. So here the two benefits are this. And I didn't say this earlier. If you have questions, feel free to interrupt me. I will do my best to talk, and also keep an eye on the chat. Daniel will do the same. But I will take questions throughout. This isn't intended to be a monologue, to be clear.
And Paul, it was kind of my mistake there because I didn't ask
Yeah.
you up front. I usually will try to monitor the chat for the speaker so you don't have to be concentrating on it. and then I could either judiciously interrupt you and bring a question up, or we could hold them to the end. Sounds like you want the former, though.
Yeah, so I am on board with the conversation. I find these to be most beneficial when I don't get talked at, but I get to talk with. And so
Okay.
that's my preference. So if you want to unmute and jump in, you're welcome. If you want to throw it in the chat, that's great too. We are open for whatever is easier for you.
All right.
So I do have the chat up, and I'll try to multitask, although I'm not great at it. So with the alternative investing inside of an opportunity zone, let me maybe just kind of share the math on the tax structure here, so you can kind of get a sense of how this works. So in this case, with this particular example, there were $1 million of capital gain taxes that would have been, or $1 million of capital gains, if he sold all of his stock and rebalanced and repositioned things. So you don't have to do $1 million, you could do any amount. It could be $25,000 is the minimum that we have, and it could be any amount over that. But in this case, what you're seeing here is if it's a qualified opportunity fund, if this couple sold their stock and had $1 million of gains, they would pay federal taxes at 23.8%, and they would be tagged with a $238,000 tax bill. So that stings. And so a lot of people don't sell their stock. Well, if you look at the QOF column and you kind of take a peek at this, you've got this $1 million gain, but you'll notice here there's a dash on what's due today. That just means that if you're investing inside of a qualified opportunity fund or an ozone, opportunity zone, you're going to get to deflect the tax until 2026, and you pay it in 2027. So that's benefit number one. Now, I'm showing an earnings of 10% on the investment. We don't have any of our alternatives that we would even start to touch unless it had a return north of 15 to 18% or higher, because it's just not worth our time. So, as far as the 10% return, what this is showing you is the growth. And the benefit is predominantly is that you get to invest your $1 million and not pay the $238,000 for 3 years. All of the earnings on that, you're actually using the IRS's money to give back to them in 3 years. So that's the first benefit, and that's why you see a distinction between 1.09 million and 1.1 million. So that's just earnings on tax dollars. You still pay it, you just pay it later. The next and biggest benefit, though, is after you hold the investment for 10 years, what you're getting with that is you're getting the compounding of this investment, and you're bringing it out tax-free in 10 years if you hold it and have it that long. And that's what the difference is a $442,000. So, and that, again, very conservative, 10% return. I won't even tell you our average opportunity zone investment return, because the yield is extremely high, and we've seen a bull market. So I don't want to set bad expectations, but there are some added rules that you need to know about this. First of all, if you have stock that has been sold or real estate that has been sold, whatever, capital gains in the last 180 days, you can reach backwards, even into last tax year, even if you did your tax return, pull those back out, amend your return, and get your tax money back and still invest. So you have 6 months backwards to invest in a qualified opportunity fund or an ozone. So that's one thing you need to know. The second thing you need to know is it is critical that you find investments that are in an opportunity zone that are actually good investments. You should never invest in something, an alternative investment or any investment, if it doesn't stand on its own 2 feet as a good location and a good return of your capital with measured risk. So we're looking at places as an example. We have a fund open now that is building in Phoenix, right across the street from the Chase Field. We have another one in Charlotte and Raleigh and Knoxville. So these are all locations where they have massive imbalance of demand and supply for housing. Way too much demand, too many people moving there trying to find housing. The supply is non-existent. 95% occupied, wait list for 8 months. If a recession comes, when a recession comes, that becomes even more imbalanced because people lose their homes and they need to get into a place to live. So that's an opportunity zone, and I just wanted to share that. one of the questions was, what percentage age of the QOZ funds are actually on track to generate positive ROI to investors? I don't know the scope of that question. I can speak for our company. We have over $1 billion of these being built. There is a distinction when you invest in a QOZ or an ozone of, are you investing in a fund, or are you investing in a fund that also is the developer? So in this case, we are both. We are the fund that is registered with the SEC. We put those together, and then we also are the developer. And that's important, because our first one that we built one of these in St. Louis, of all places, for $26 million. We had a bunch of investors for a portion of it, and then the Anheuser-Busch family for the bulk of it. We went in, we built it for $26 million, took 2 years to build it. By the time we were done, we hadn't put one tenant in it yet, and we start getting calls from all these New York firms that had all of these big old, investment funds, that they're not the developers and they had nothing to buy. And the rule is you have 31 months to deploy the funds to be in accordance with the law to get the benefit. So they're like, well, what do? We need to go find some things to buy. So they call us up and we're like, it's not for sale. Sorry, we're only 2 years in and we got to go 10. And they just kept hammering us. So we said, all right. They asked us what our number was. So we looked at the pro forma and looked at year 10 and we said, here's our number. It's $48 million. And we only put in $5 million of equity. So I was going to return that. I won't even say the percentage because it's huge. And that is our number, because we sold it. And the clients would have had to pay tax on it, the investors, but they chose, most of them, to reinvest into our fund that I'm actually talking about right now. So that would be the answer to your question. But I would say be very careful with the ROI, because most of them you're not going to see that, because they just started in 2017. And that means they've got 5 more years to hold before you're going to see a return on investment or an IRR. One last thing I'll say about ozones. I know 10 years, you're like, good heavens, 10 years, that's a long time. We don't think about anything in 10-year increments anymore. We're thinking about next year. We get it. So what I look at when I put my capital in on these kinds of things is, we will take 2 years to build this, and then it takes 1 year to lease them up. I'm giving you the average. Some it's a little faster, shorter, whatever. But 3 years is done. Now we do one of two things. Either we refinance, because now we built it at this cost and the value leased up has gone up by 30%, and our loan was 50% of the cost to build, which is now only 20% or 30% of the new value. So we can lift the value of the loan and make a distribution of, let's say, 80% is our average distribution. So in this case, 800,000 goes back in year 3. Perfect timing, because you can pay a portion of it to pay the tax, and then the rest of it you put in your pocket. Because it's a recapitalization of basis, there's no tax on that initial distro. And then year 4, 5, 6, 7, you're collecting rent coupon checks, right? So that's how you get that set up. What types of properties are we doing? We are doing multifamily and not low housing, not senior housing, not student housing. We are doing standard rent deals in places that need housing. So it's the same locations that we're doing non-ozone deals. So again, we can build them, 2, 3, 4 blocks apart. One's an opportunity zone and one is not. We don't care. The tax is important, and there's good reason to leverage that if you have capital gains. But certainly these areas need to stand on their own. So the other question is, once somebody invests in a fund, does that fund stay in the given property or is it fluid? Another great question. It needs to stay in the property. If it does not, it creates what's called an inclusion event. Very tricky here, because that means that you put money in that had no basis. It's all gains. And then you sold it, you made more money with it. So now you have a lot of money of return. So if you sell that, it does what? Triggers tax. Within a fund, you still pay the tax, and it's spin out and it is included as if it wasn't in the fund, and you lose the benefit. The only reason you would do that is if you dominated on the return, so much so, like we saw with one of our early ones, that it made sense to recognize that and pick up a 60+% return. and a lot of people invest into the next deal. Okay, great questions. Keep them coming if you've got them. So let me just talk about risk here for a second. You know, when you build a portfolio, the gold bar is what most people do. You guys are an alternative investment club. I think you are drinking the Kool-Aid of the black line. I just thought it'd be cool to show it to you in the form of standard deviation and annualized return. I geek out on math stuff. And so when you look at standard deviations, the bottom line, what you're seeing here is when you introduce even just 20% of alternatives, it pushes your return up without adjusting your risk, which is slick. More money, same amount of risk, or in some cases, less risk with the circles on the right. So let me go into another concept here. So I'm sure with a group this size, some of you have heard about taking an alternative investment and dropping it inside of a qualified plan. Let's call that an IRA. You cannot put an alternative with leverage in a 401k. Okay, so if you're thinking about that, you're like, I'm going to go set up a consulting business on the side and have a 401k, and I'm going to put an alternative that's a Reg D product inside of it. Don't do it because you're going to blow all kinds of risk guidelines. But what you can do is you can take retirement dollars, move them pre-tax, or I should say non-taxable, into an IRA. I think many of you probably have done this. If you don't have that, you can start funding a non-deductible IRA. You can do it that way too. And then flip that to the Roth IRA, which is what a lot of people come to us. And they ask us the question, should I convert my IRA to a Roth? Now, I think we have probably a younger demographic here making some judgments. I don't see lots of faces, but for those that I do see, I don't think anybody is over 72. So if you are, you start getting notifications that say you owe us, is the IRS, money, and you need to draw down your IRA. So a lot of people make the mistake when they're younger of piling up huge balances in 401ks, and then they get to what Glenn just said, an RMD, a required minimum distribution. And these are nasty little love letters from the hate letters, more like, from the IRS saying, you got to pay us up. So how do you avoid it? Well, you can convert your IRA to the Roth IRA and pay the tax today. Now, most people don't like doing that. In this situation, in this graph here, we were showing for this client a $250,000 conversion using an 8% rate of return in a 37% tax bracket. That's what's in the small print on the bottom. So this is what it looked like for this 48-year-old out at age 70. If they flipped it over and did a normal conversion from an IRA to a Roth by way of funding it, take the 401k to an IRA, move it to the Roth, they would have an added $230,000. So that's great. But what if we did something instead and we said, let's buy alternative investments inside of this said IRA? What does that do? Here's the impact of that. Same amount, same dollars, 250 grand. All I did was I said the IRA, we convert it, and then in the Roth, we invested in an alternative making 14% instead of 8%. We kept the tax rate the same. That's a significant difference, $230,000 of value, of added value versus $1 million, the orange bar being the Roth IRA at age 70. Okay, so now I just showed you how to take that. We're gonna take this down Dorothy's rabbit hole a little further. And I don't have my whiteboard, and I left my iPad in the car. Otherwise, I'd be scribbling on a pad for you so to follow this. But I think I'll try to explain it, and we'll see if we can follow. So the IRA. Let's go back to this guy. He's got $1 million in the IRA. What happens if we take the IRA and first invest in a bunch of alternatives? We can do private credit if we want to be conservative. Right now, lending out at 15%. We have a fund that we're lending out money, and we're collecting 15% for our investors. And it's owned. You can put it at Charles Schwab, and you can see it on your statement. It's through their due diligence. Or you could put a real estate project. We have one going up in Denver right now, and a whole bunch of other places. But you could own that in your IRA. Now, you're a limited partner with your $25,000 check or whatever, and it's in your IRA. So we get a third-party CPA firm to come in and say, what's your limited partner share worth? And they look at it and they go, well, Daniel can't sell that anymore because he's locked up for 3 years or 5 years, whatever the duration is of the project. And so lack of control, lack of marketability. So we're going to apply a discount to it. Now that discount can range. It might be 30%. It might be 35%, 40%. But that $1 million is no longer a million in the IRA when you convert it. It's now valued for the LP, the limited partner shares, at 600,000. So the 600 is what gets ported over and drops into the Roth IRA. You still own $1 million of that investment, but it's taxed at 600. You can imagine what that does when you take your tax bill and you reduce that further down. In this guy's case, instead of paying income tax on $1 million, it was 600. So we saved taxes on 400,000 before we flipped it over to the Roth. And those numbers aren't even assessed on here. The green increase goes way up. So I've got a couple of questions here. I'm going to try to get to those. So the first thing is, what if we are in a higher tax rate? Is it still worth transferring from the IRA to the Roth? Excellent question. So here's the question I like to ask people when they're retired. How did it work out for you? And what I mean by that is, are you indeed in an equal or lower tax bracket than when you were working? And they scratch their head, is like, yeah, by golly, I'm actually in the same bloody tax rate as I was when I was working. And I didn't expect that. I thought I was not working, therefore my tax rate was going to be lower. And it's funny because it's a bit of a misnomer. People assume that when they're working, they're going to be in the highest bracket. And when they stop working, they're going to go to a lower bracket. Well, we work with thousands and thousands of accredited investors, or coast to coast. And very few of them go in a lower bracket. So in this case, I would tell you, even the math here shows that, because I kept it at a 37% bracket for this. But if we can use that suppression of value, putting alternatives that you guys are familiar with in an IRA, that actually brings your current tax bracket down. If you did the math on it, $1 million converted, take 40% off. So now you're at 600. That's actually going to be a lower tax rate, an effective rate on the 600 converting, even though you had $1 million come over. It's like a 22% rate, rough math. So good question, though. The next question is, does Larson have any enhanced Roth conversion projects that offer discount on the valuation? Yes, we do. I'm not going to talk about projects today per se, but here is one example of that. This is going up right now. We're almost full on this. Maybe we have $9 million left of this 34. But this is just north of, it's called Hambright Junction. It's north of Charlotte by about 20 minutes. And you can kind of see the details there. We can go through this stuff later, but the key when you're building is, what's the cost to build? $273,000 a door. And then what's the exit value? $426. That's current market, current interest rates. If we trend rent up at 2% lift a year, that's how that works. But we take this, a lot of our investors that are in this, it's qualified money. So, all right, let me keep going here. This is another project, same thing. It's inside, it's a build to rent, and it's in St. Louis, Lake St. Louis. This project might be full. It's a bigger project, but it filled up pretty fast. Let me go to REITs for a second. Some people invest in REITs. Some are closed-end REITs. And what that just means is you're putting money in and then they stop bringing investors in. And then you fulfill a term and then you get out. This isn't necessarily the same, though, as doing a private fund. There's one key distinction, and it's the way that taxes work on depreciation. When you are in a REIT, you do not get the same level of depreciation that you do when you're in a private fund. So again, going back to my premise of how the glasses that I wear, that I forgot in my Tesla this morning, are keep your taxes low, because that's the biggest creator of value when you're talking about investing. So if you have REITs, usually we would want, for people who are in higher tax bracket, is to stop doing those, get out of that position, reallocate and drop it into a private fund where you pick up much larger depreciation, because you're doing cost segregation and you're compressing losses on paper to take funds out on paper against the rent income and therefore you write off that expense. Now, some of you superstars who have already done a bunch of these alternatives, and you've got all these K1s that show up that were probably late, so you couldn't get your tax return done. Those are coming in, and you might have positive income on a K1. How do you deal with that? Well, we go out and we find investments in different types of asset classes that align with our goal. So for instance, we're building warehouses right now. Those have pretty good depreciation in the first year. So if you need depreciation now, an industrial center works excellently because it takes not long for us to tilt the walls up, and we can write it off in year one. Multifamily, not so good because it takes us 2 years to get that thing done, and we're doing the cost seg in year 3 usually. So that's a longer delay to get that. Office is great, but nobody wants to buy office right now, so I'd steer clear of that. So you get the idea on REITs and depreciation and the importance of that. How many funds or projects do we currently have? I think we have 42. So we're a pretty large firm, and we're multi-asset class. But right now, I tell you the 3 asset classes are industrial, multifamily. I'm going to include build to rent in there. And then we are getting into, we've got office, but nothing available today. Those are ones that are already owned, mostly in Texas, where they didn't believe COVID actually happened. So they do still go to the office down there quite a bit. So, all right, let me see if there are other questions. So the question about will slides be shared? Absolutely. Daniel has them. I'll certainly be happy to send those out to you so you can dig into them more. Let me throw one more thing at you on a tax piece. So I know we have a younger demographic, but I think this is important because the things that you set up in your 40s and 50s are things that will carry on for longer periods of time. If you're not familiar with a family limited partnership, these are really cool structures because in essence, what you're doing is you're opening up a partnership, or it can be an LLC. And let's say you're married. So you and your spouse are the general partners of this said FLP, family limited partnership. And then your investments into the investment club that Daniel's got set up, into whatever else it is that you've got. What we do is we own that in your FLP. Well, why would we do that? In part, so that you can protect the assets even stronger and better from creditors. The limited partner shares are also owned by you and your spouse initially. So 98% is owned there, and 2% is owned in the general partner shares. And inside of there are all your real estate deals and maybe some stocks and things like that. So what we do there is over time, we start giving the shares of the limited partner out of your estate. Now you're like, well, where am I going to give them? And what if I want my money back? Well, those are good questions. The reason you would give the shares of your LP interests away in your family limited partnership are because you're trying to reduce your estate size. Now, maybe some of you know this already, but this is what's about to happen. Unless we have a Republican Congress and House, Senate, and President, it's very unlikely that we are going to see this tax law extended. And what this is it's the death tax. So it's estate planning, and you can see it skyrockets here for 8 years or so, and then it goes back down in 2026 to roughly 6 million per person. If you die and have more than 6 million net worth in your name, it is a 40% tax rate federally, plus whatever state is, depending on the state that you live in. It's expensive. So back to the FLP. If you are giving shares of that family limited partnership out the door to somebody else, it reduces that size, and you can give up to a lot more this year. And the general partner still controls everything that goes on inside of here. That's you. So you can give money to kids without them even knowing that they have it, and ultimately having zero control. And if you don't want them to have it, you can borrow money out as the general partner, or you can take a salary or a fee and you can wash that thing down if Johnny or Susie do stupid things that you don't approve of. So there's a lot of flexibility inside of there. But again, I share that because these are very commonly used to hold your investments, particularly in alternatives. So think of it as like you establish this, and then anytime you invest, you have this FLP that is what's buying into investments, into the investment club, into this, into that, and so on and so forth. So, all right, let me go back to my questions here, see what we've got, and then sometimes you start talking for too long and it's too much data. So we'll open it up for conversations. I'm probably done with my sharing of the deck. Let me just real quick show the FLP structure. This might be helpful for those who like to see the pictures. Not that. Sorry, those are historical performance. This is the breakdown of how that works, so you can kind of visually picture how things roll. Okay, so let's get to some questions here. The slides are already shared, so Daniel is a rock star. He doesn't let grass grow under his feet, so they are linked in there. You can take a look at it. Next question from Sheesh was, I missed how you discount the valuation, and can you explain where the discount comes from? So the discounting, whether it's inside of this family limited partnership, anytime you have limited partners, just by the name limited, as if that's you investing in one of these projects that we have in Charlotte or Denver or whatever, or if it's your family limited partnership, those are both limited partner investments. And the limit is that you don't control anything except for your initial investment, and you get to decide if you want to do it and how much. After you make that investment or you take ownership of it, that's where you're limited. You're limited to only lose what you put in, and you're limited to decide how much and when. But everything else is done by the general partner. So as an investor in one of these projects, let's say, in this case, the $1 million that was invested in an IRA as a limited partner, we go out there to a CPA firm, and then they will assess the value of those LP shares. And they'll say, this is discounted at some level because of the lack of control and lack of marketability. On average, we see 30 to 40%. Sometimes it's lower, sometimes it's higher. So on the $1 million valuation in an IRA that's invested, not in stock, but in these, it could be real estate, private equity, oil and gas, a whole bunch of them. We got all kinds of different ones that we manage. You own that in your IRA, that $1 million now goes down to, let's say, 600,000. So now the amount that goes on your tax return is 600, not the million, but the whole block of investment moves into the Roth. Not to go too far down the rabbit trail, but I think there are other things you can do in that particular year, because that will juice your income. If you're making whatever, 150, 200 grand is your day job, and then you strap on that thing another, in this case, 600,000 of taxable income, that's a lot of taxable income. So you can also fund like a donor advised fund, a charitable thing for the future, but you do it in that front year to push your income back down. So anyway.
Hey, Paul, I had a question, and I also wanted to say that you earlier mentioned that people could just take themselves off mute. So feel free to do that if you want to do that. I wanted to ask, in the family limited partnership, when I've included, say, my children, child A, child B, child C in this, are they taxed at my income level, or are they taxed at their minor status income level?
Yeah, great question. Sorry, I'm trying to get rid of this thing that my mouse is jumping all over the place here. They are taxed at the entity level and not the parents or their level. But most of these are flow throughs, which then goes back to their individual level. So it's a flow through business. You can have taxation as a C Corp or an S Corp, a flow through. Most choose the flow through, so it's going to get taxed at their individual rate. Now, that opens up another conversation. You've got this thing called a kiddie tax. It's KIDDIE. And this is a tax thing that came out probably when I was 15, 20 years ago. I was in my 20s. And I remember it coming out because people thought they were smart. They're like, we're just going to put all this money into the kid's name, and then we're going to get out of our capital gain taxes and let our kids, because they don't pay tax. Well, IRS wised up to that pretty fast, and they slapped on an additional tax after you get to a certain threshold of earnings. That's the same thing here. But if we have alternatives inside of the FLP and we manage this well, meaning we go in and we invest in Don's deal in Florida, and we buy some of his stuff, and then we buy some of this and some of this. We put them all together. What we're doing is we're managing the income tax efficiently inside of the FLP, so that it nullifies the taxes. If we go for yield or cash flow and we buy X, Y, or Z, then this one we buy something that's not cash flow but big depreciation to offset that X, Y, or Z investment. So it's all about how much you keep, and it's all about the plan and the architecture of structuring all of the pieces to work together. It's a spaghetti bowl, and you grab a noodle, the whole pile's coming with you. If you invest in one thing, it ripples through and hits everything else. And in this case, if it's done wrong, I just had a client we just brought on, and it was 87-year-old and had a lot of money in one of these, 80-something million dollars. Kids are in their 50s. He passes. The kids are now saying, oh my gosh, he was paying all these taxes, but now they're hitting my tax return, and I don't even know what to do with it. And it was putting them in the highest bracket, and they weren't even doing the basic planning to reduce their taxes. So that's why I say it's all connected. But great question. Okay, now the questions are pouring in. Let me try to roll through some. Yeah, go ahead, Daniel.
Oh, I was going to say that I used to put money for my kids' college into the Oregon State Plan, and this is actually now how I structure saving for their college.
Yeah.
I've found it's actually very good at limiting their taxes, and I get a whole lot better investment options than I do from Oregon.
Yeah. I don't mean to go down too many so probably drinking from a fire hose, but here's another cool thing. You can load up a 529 plan. You can send all the cash in. Kids don't go to college because they're like, I'm going to go do business myself. I'm not doing that college thing anymore. Whatever, they launch something, and now you got all this pile of money in a 529, and you're like, whoa, what do I do with all this? You can go back to sailing school yourself in Hawaii and register for a class, or you could convert it to a Roth IRA. And then once it's in the Roth IRA, up to 75 grand and 15 years holding it, as all caveats, you can actually then put it back into the alts. So it's like come full circle, and it's in a Roth IRA, zero tax, pretty slick. So anyway, but yeah, it's great to use this for children, and I actually prefer the FLP like Daniel over the 529 for the same reasons he does. Okay, let me go back to my questions here. When I have this is from Glenn. When I have an alternative investment and it's in my name, is there resistance by sponsors to deal with retitling to an FLP? Yes, is the answer. Most will not like that. It's a lot of work, sadly. It's just a lot of effort. So my encouragement to you would be invest in projects that will allow you to do that, and then start with it up front. What they don't like is the sponsors don't like, and we don't like it either, but getting the investment and then having to repaper the entire thing into the FLP. That's a royal pain. But it doesn't matter to me so long as I can look at that FLP and see that it is an accredited investor and the people in it are accredited, or it stands on its own as an accredited investor, and then we can receive the funds. And we've already talked about some of the different reg statuses. Some are accredited and some are non. We do both, and so Daniel, we can talk about that later. But that's relevant on the FLP question. Okay, so how does the FLP work if you have a trust set up already? Excellent question, William. So up on the top where it says parents, non-qualified assets, that usually is a trust that's funding it. If you've done your work and a revocable trust is established, you would have the revocable trust send the money down, and guess who owns the LP shares and the general partner shares initially? Your trust, your revocable trust. I don't have a bubble on that, but you would have the Rev Trust own those shares. And that's important because when we all die, you want those shares to go up into your trust, and the trust will dictate how that person is sat. And usually you set up a corporate trustee, and that's when a group like ours comes in and takes your chair and fulfills what you put into your structure on your trust. And that's our estate planning division and trust planning division. Yeah, go ahead.
I was going to say a quick aside there. I know that when I left Intel about a year ago, there was a $17 a month legal plan where you could, they had a variety of legal services, but one of them was establishing a revocable trust. I think there was some chatter, throw it in the chat if I'm wrong or right about this, but is that benefit still in effect or was it removed? I know at least a year ago that was a great way, at least if you're an Intel employee, to get a fairly
Then it
boilerplate and
says it's still
inexpensive
there.
trust.
It's
Still
still there,
Yeah,
there.
yeah.
Great. Great.
yeah, we've got
Yeah, the
some
Hyatt legal plan.
confirmation.
That's what it was. $17 a month, and it gave me like a $3,000 standard revocable trust.
Yeah,
Good deal.
those are really good, and I think I think when you consider estate planning, there's like basic level stuff of wills, trusts, power of attorneys, revocable trusts, like bypass trusts, that'll be revocable. Then you've got healthcare directives and POAs, power of attorneys. Those 4 sets of documents, so it's 8. Those are manila cookie cutter, pretty standard types of stuff, and you all should have them. If you don't, then nobody knows when to pull the plug. Nobody knows who's going to take over the assets, and it's very public. So that's called probate. So you want to get that done. But ideally, if you've got a more complex estate, you probably at some point will want to have an estate planning attorney. Pay the $4 or $5 grand; it's worth it. In this case of this $85 million deal, I've been working with this guy for a couple of years, and I got a phone call 3 weeks ago when I was in Houston doing a meeting from this guy, his contact, and he went in for back pain into surgery, and they opened him up and found it was filled, cancer had metastasized all over his body, and once was a healthy guy when I met him a week ago driving a tractor, was gone within 7 days. Now he's older, but he was saving money on attorneys to draft up the full plan for a very complex estate. And he saved the money, but he ended up paying well, he's dead. His kids will end up paying $22 million in estate tax. So be careful. So it's a good starting point. The question here, Ashish asked if Larson owns funds independently audited. Yes, actually I have a boardroom filled with auditors for 3 months of every year. We actually have their own area that we set them up. So there are Forbes, that used to be BKD, does our audits. We actually have audits on the fund level. We have audits at the parent level of company, because we own and operate 7 operating companies, a tax firm, private equity, all these different businesses within the structure. So we have to have lots and lots of audits. All right, so isn't there a per year amount limit on 529 conversion to a Roth? It's a great question, Arvinder. I don't know if it's a per year or there. I actually think it's a set dollar amount. The number that I've heard, and I'll be honest, I haven't implemented this plan yet personally, although my kids are some of them are leaving college, so I am looking at doing this. I believe it's a $75,000 maximum. And I think the rules that I've heard are you have to have it 15 years that's been opened. Mine hasn't quite been there yet. And then the other question that I have is, what I've done is I've piled up 529 for one kid with the plan to move the beneficiaries. And what I don't know is if I can take out 75 grand, give it to one, convert it, change the beneficiary, do it again and again and again. That part I'd be shocked if you can pull that off. So great questions. I would have to ask one of our financial planners on their team. All right, great questions. I got a lot about the legal plans. Excellent. You should do that if you haven't done that. It's a very cost-effective way to start. All right. So let's see here. I think I've got, the fees. So how do we charge? We are set up as a family office. As you can kind of see that we cover a lot of ground in a lot of different areas. But we also work with people in really 2 capacities. One is to look at the full picture and figure out how do we create value. And that piece, the charge could be tied to net worth, or it could be tied towards investable assets. And that's just, I don't know enough about a person until we have an intake meeting where it's more of a 30-minute just check in to see what is it that you're trying to do. We'll tell you if we can add value, and then we'll lay out a plan, and here's what the cost would be. So that's a family office piece. If it's more of just I want to invest in this project, cool. then we can go in and it's a standard 2% and 20% fee above an 8 or a 10% pref return. Said differently, the 2% asset fee, and this is standard pretty much in the industry, but the 2% is the operating cost when you put a partnership to go buy real estate or an alternative, and that covers all your employees internally. It's a break even for us. We don't actually make any money on that. Where we make our money is when we sell the investment and get the heck out of there. After our investors get an 8% or a 10% rate of return. Once they get to that 10 or 8% rate of return, that's where we're making our cash because we get to share. So if we can make it 22%, then you get your 10, then above that we share 80-20 is a typical structure. So 80% of the above 10 goes to you with your 10, and then 20% to us. So that's a very standard fee structure. Obviously, if we do your taxes, we just charge a tax return fee. So to illuminate that, I referenced that ozone deal, so I'll just show you that. This was how much we put in, and I was going off of my memory on numbers, but these are precise. So we built this as an opportunity zone, as a 10-year pro forma with an 18% return. We started development in 2020, put in $7.5 million. We gave back $12.7 million to investors, and we sold it for $46. So this 27% net rate of return was annualized over those 2 periods or those 2 years. And so if you group that together with all of our closed, we have another project. Sorry, this is the one I wanted to show you. I hit the back button there. So if you look at all of our opportunity zone investments, this one, and then we had an office tower we built for a company that went public, and you average those together, we've got a return that's extremely high. So be careful not to set your expectations that a 31 or a 60% is normal. It's not. So just keeping that out there. Okay, I am right on my time. 2 minutes left. This is my contact information. Daniel has it. I've got it here on the screen for you if that's easier. You're welcome to drop me an email. I'd be happy to chat with you, and we can talk, for 10 or 15 minutes or whatever, or we can set up a time to go through your individual questions. But let me see if there are any other questions about anything that I did not cover or you would like to cover about tax.
And of course, if you want to rewatch this, it's going to be available on the YouTube channel as well as in our Speakers Hall of Fame on the Alternative Investing Club website. All right. Could everybody here take themselves off mute and thank Paul for coming in and talking to us today?
Hey, thanks, Paul.
Thank you so much.
Thank you, Paul.
Thank you, Paul.
Thank you,
Paul.
Thanks, Paul.
Thanks.
Yeah, great
My
presentation.
pleasure. That's a lot of voices. Great to see you guys. Really appreciate it. I hope you have a wonderful weekend. And yeah, we'll be here if you have any other questions. Daniel, so good to see you again. And yeah, let me know if there's anything else you guys need.
Than-bye.
Bye-bye.
Thank you, Paul.
Thanks.